Hello to all of our lovely clients. Siobhan Ashby here from Northeast. I'm here to deliver our summer market update, and I'm joined by a very special guest. I have Tim Samway, who is the Executive Chairman from Hyperion. Hi Tim, how are you going?
Very well, thank you. Thanks for having me along today.
Thank you so much for joining us. So to everyone playing at home, which is, I dare say everyone, given that we're in COVID, of course, Hyperion Asset Management is a very reputable equities fund, and a fund that we're really excited about and using more for our clients. So we thought that this would be a really great opportunity for you to hear from the experts about their outlook for 2022. So Tim, in January, we saw some big sell-offs across domestic and international equities. What were the main drivers of this?
It's big macro drivers, so big top-down drivers. What I mean by that is it's fear of interest rate rises, and it drove the whole market to move away from businesses that have earnings that are growing over long periods of time in the fear that the relativity between interest rates and those earnings would make those earnings less valuable. And so the market expected interest rates to rise over the next couple of years quite substantially, and it's a bit of a knee-jerk action. So what happens is it feeds on itself. Everybody's trying to get out at the same time, and you see some pretty big falls, and you've seen that. Some of the companies that don't have any real profits got hit the hardest, and some businesses that are actually very profitable and produce lots of cash flow haven't been hit very hard at all. So it's not been an equal rotation, but certainly it's more that fear of inflation and the interest rate rises that will be executed by central banks around the world to cap the risk of inflation that's actually driven this.
Yeah, certainly. And interesting that you bring that up, because there's been huge talk across the media of inflation lately and what that will do to markets. So can you explain for our clients why rising inflation makes equities less favourable?
So it's not equal. So that's the first point, is that there are plenty of businesses out there, and they're the ones that we invest in, that actually don't get all that affected by inflation. So the secret to being able to prosper in an inflationary environment is an ability to actually have the ability to increase prices to customers as inflation takes a hold. So what we're looking for is businesses with pricing power. That is, their services are in high demand. Customers will pay extra for them because they are the best services or products. And as a result, as inflation takes hold and costs get higher for business, whether that be wages, whether that be rent, whether that be input costs, whether it be energy, whether it be freight, all of those things are part of the inflationary cycle. They're able to keep their earnings, their revenues and their earnings up because they can increase prices to customers. Businesses that can't do that will struggle. And in spite of the fact that there's a whole lot of businesses that the market is rotating into at the moment that I would call old world businesses because they are paying dividends, the dangers for them are that they are generally less competitive than innovation-focused, newer age businesses. When I mean newer age, I'm talking about the last 20 years, not the last 3 years. It's, businesses have been around for 20, 25 years, but much more focused on innovation. Those businesses actually do prosper in times like this, but the market gets nervous about the effect of the interest rate rises on their ability to keep producing those earnings in the long term.
Okay, well, that's really helpful to explain. And I think that you've raised a really good point around the value of, sort of those more traditional growth stocks that pay dividends versus the value stocks. So over the past few years, we've seen growth stocks outperform traditional value stocks. So with valuations being tested, is there some merit in having more exposure to well-established stocks paying regular dividends based on the situation at the moment?
So that outperformance really has occurred over the last 10 years, since basically early 2012. growth stocks have outperformed value stocks. And there's a reason for that, is that in periods of falling or low GDP growth, gross domestic product, or economic growth, older world businesses struggle because they rely on that underlying economic growth to drive their sales, to turn that into earnings, to pay dividends. So, those increases from year to year that bolster those dividends and make them worthwhile holding actually are not there in periods of falling GDP or flat GDP growth. And that's what we've had for the last 10 years. I mean, if you look at a long-term chart of GDP growth or economic growth over the last 30 years, it's been a slow decline. It's a graph that's just gone slowly down with some moments like this, go every now and then we get a bit of a spurt. But in those low GDP periods, value businesses have found it very hard. They're not as competitive as new age businesses that are working out how to do things with IT platforms, delivery systems. And as a result, we're in a period now where there is a surfeit of short-term growth as we come out of this pandemic. So there's been a whole lot of money provided to the economy by way of transfer payments to the populace to offset their ability to earn income. And in many cases, because of the pandemic, and in many cases, that amount has actually been in excess of what they would have earned if they'd gone to work. And they've sat at home and done virtually nothing in lockdown for periods. And so they've had excess money. And that's created a surge of short-term growth as we come out the other side. And that's given these older world businesses, these value-based businesses that pay dividends, a boost, and they will have a short-term boost. But we think that the next 10 years, which is the period you should be thinking about investing, just looks like the last 10 years once you take out this next 1 year period. So, you asked the question, what are the risks and the opportunities? Well, in the short term, there's a lot of volatility. I look at stocks that go down 10% in a day and then up 10% the next day. I mean, that's madness. That's just sentiment driving that. There's no way that the underlying valuation of a business actually varies by 10% in a day, because like the day after the next day, they just basically earn pretty much the same as they did the next day. Most businesses are like that. And so that's the risk, is the mindset of, oh my goodness, what are we in here? This is making me nervous. The professional mindset, so this is how we think, is that's an opportunity. When a perfectly good business gets marked down that far, that's just an opportunity to buy a great business cheaper. And that's certainly what we've done. We've deployed nearly all of our spare cash. We were holding about 8 to 9% cash in our portfolios coming up to November. We've deployed that cash into stocks in the portfolio because they're just cheaper and better value than they were 2 months ago.
That's a really interesting perspective, and I'm glad you touched on that, because it is, of course, a bit of that herd mentality of selling out when things go down. And of course, there's many different reasons for prices to decrease, but I'm very glad you touched on that point, because I think it's a very valuable point to make to investors. And candidly, and of course, I'm sure you'd share the same sentiment. If you're not prepared to watch your stocks go up and down, then investing is probably not for you anyway.
That's nothing. Never a truer word was spoken.
Well, so we've seen a big and positive movement towards sustainable portfolios over the last few years. And I can certainly say, as an advisor, a lot of my clients are having more of an ethical investment preference. In your view, are they going to continue to be weighed down if the big tech stocks underperform?
Very good question. So the greatest risk of our time is actually climate change. The level of carbon dioxide in the air. I mean, did we really expect that we could undo millions and millions of years of carbon sequestration where fossil fuels were created through forests that were laid down and carbon was taken out of the air, and we could undo that in 100 years with fossil fuel burning with no undesirable consequences? I mean, seriously, now we look back at it, it sounds like stupidity when I say it like that. And so, we are now on our way to at least a 1.5 degree world increase in temperature, and maybe 2 degrees. And the number of people that now doubt that is diminishing with every passing year. I mean, I know there's a hardened core of people who just don't believe in man-made climate change. But let me tell you, the smart money is already pouring in to prepare itself for this carbon constrained world. I mean, I want to put it into context. So a 2-degree world doesn't sound like much because I'm sitting in a Sydney day today and it's 30 degrees outside. And you just think, well, if it's going to be 32 degrees, well, I'll just crank up my air conditioning a bit more and I can live with that. But average temperatures make a big difference. So the last time we had an ice age, the average temperature of the Earth dropped 4 degrees.
Gee, that's not much,
in a 4-degree dropped world, New York was under 2 kilometers of ice.
2 kilometers. Oh my goodness.
So I just put these things into perspective that, 2 degrees actually is very serious, and this is going to become a very substantial opportunity and a threat to investors. So, I mean, you can take the short term and look at, okay, so some of these tech businesses, which are very carbon light, are having a difficult time at the moment because their prices are down. Or you can take the 20-year view is it's the only way by investing in these businesses that you're going to have a hope in hell of firstly addressing climate change, the challenge of climate change, but also making money out of it. Because businesses that are not prepared for a carbon constrained world will actually go broke when we eventually realize that the only way to control the use of carbon is to price it. Like, governments are resisting it, because it just looks like another tax, but we actually will have to put that tax in. By the time we're at 1.5 degrees, we'll be on a trajectory for 2.5 and 3 degrees. I mean, half the world will just die. So there'll be no choice. It's just when, not if. And I think professionals understand this. And while there'll be some great money to be made in the next couple of years out of buying fossil fuel businesses, because look at the oil price, it's rocketing up. In the long term, a lot of those businesses in a carbon constrained world with a carbon price will go promptly broke. And you don't want to be investing in them when that happens. So it's not if, it's just when. And we think there is real advantage if you take a long-term view in getting ahead of that curve. And that's why our portfolios are extremely carbon light.
Okay, well, thank you very much for those insights. And I think that that's actually really going to help explain that to a lot of people who feel uncertainty, because my experience in this with clients is that sometimes they feel as though the additional cost of sustainable investing might not be worthwhile. So it's really, really helpful to have that perspective. There's
never been a momentous opportunity like this in history where it hasn't been the right thing to get out of the wrong side of it over time.
Yeah.
So, there was never, I mean, I can go through the whole list of things that now we look back and you shouldn't have invested in them. And basically all of them, it made sense to get out early.
Yeah.
And carbon is definitely one of those.
Okay, well, thank you for that. My final question for you today, Tim, is what's your outlook for domestic and international shares in 2022?
Yeah, so it's a great question. I've never been guilty of giving a 1-year target, and I'm not going to change now. We think in 5 and 10-year increments. Because it's actually impossible to tell you what the next year looks like, because that's a sentiment. In the short term, prices move on sentiment and not underlying earnings. In the long term, earnings and price, actually the price of the shares or the price of the asset, actually correlate quite strongly. And essentially what happens is the price of a portfolio or a share actually mean reverts to the earnings. If you understand what that means, it's like it's range bound. It can only get so far away from the earnings. And so as long as you're getting those earnings right, you'll get the price right, but you just need to take time to do it, because in the short term, the market doesn't do that. We think there's a whole lot of older world businesses that will struggle. They will do single-digit returns, where we think that growth companies that are well built, that are cash flow positive and are stealing market share from older world businesses, and are innovative, reinvesting in research and development, reinvesting in their workforce, attracting high levels of intellectual capital from around the world, getting the smartest people, will actually deliver double-digit returns over the next 10 years. And that's pretty satisfying, because even if interest rates went up to 2 or 3%, it's still double-digit returns is a heck of a lot better than 3% returns.
Unquestionably, absolutely. Well, Tim, thank you so much for your time today. I'm very, very grateful on behalf of Northeast and our clients for your time. This has been extremely valuable. So thank you so much.
It's been an absolute pleasure. Thank you very much.
Bye.
Bye.